$2,000 a share. Say that number out loud, and it sounds absurd for a memory chip maker most people ignored 18 months ago. But Wall Street's most aggressive analysts are putting exactly that price tag on Micron. And after digging through the numbers, I don't think they're just chasing a chart. Micron shares closed near $11.54 on June 30th. So 2,000 implies roughly 73% upside from here on a stock that's already climbed about 800% in a year. That's not hype.
There are 3 specific reasons behind it, and I want to walk you through each one like we're reading the actual filings, not the headlines. Before we go further, if you're serious about understanding how these AI-driven supply cycles actually move stock prices, hit subscribe now. This channel breaks down exactly this kind of setup every week. No noise, no recommendations, just the mechanics behind the moves.
Reason number 1 is the supply and demand imbalance in memory itself. Micron makes 2 core products, DRAM and NAND. DRAM is the fast, active memory that sits next to processors and GPUs while they're crunching data. NAND is the long-term storage that data centers rely on to hold everything once the calculation is done. Right now, both are in short supply. At the exact moment AI infrastructure spending is exploding. Every new AI server rack needs enormous amounts of high-bandwidth memory to feed the GPUs. And that demand has simply outrun what the industry can produce.
Micron's own management has said they don't have visibility into when supply will catch up with demand, and that tightness is expected to persist through 2027 and potentially beyond that. When supply is constrained and demand keeps climbing, pricing power shifts entirely to the seller. That's exactly what's played out in Micron's recent results, with dramatic price increases across both DRAM and NAND, driving record revenue and a sharp jump in profitability. This isn't a company selling more units at the same margin. It's a company selling into a market where it can charge meaningfully more for the same chip. And that kind of pricing power tends to compound quickly on the bottom line.
You can see this show up directly in the numbers. In its most recent quarter, Micron's DRAM revenue roughly tripled year over year to about $31 billion, while NAND revenue nearly quadrupled to just under $10 billion. Gross margin jumped from under 40% a year earlier to the mid-80s% range in the same period. And management has guided for that margin to climb even further next quarter. Revenue guidance for the current quarter sits around $50 billion, well ahead of what analysts had modeled just a few months ago.
On top of that, Micron is fast-tracking its next-generation HBM4 memory, the chip architecture GPU makers need for the next wave of AI accelerators, at roughly twice the development pace of its prior generation. That matters because it signals Micron isn't just riding today's shortage. It's positioning to stay at the front of the technology curve as the AI build-out moves into its next phase. Reason number 2 is something that doesn't get nearly enough attention outside of earnings calls, and that's Micron's strategic customer agreements. During its most recent quarter, Micron signed 16 new long-term agreements that lock in a significant share of its DRAM and NAND production all the way through 2030. Most of these are structured as take-or-pay contracts, which means customers are obligated to pay for their allocated supply whether they take full delivery or not. Think about what that does to a business model built historically on brutal boom and bust cycles.
It converts a chunk of Micron's future revenue from a guess into a contract. 14 of these agreements alone represent roughly $100 billion in guaranteed minimum revenue. And here's the detail that really stood out to me. Management has said that even at the floor price built into these price-banded agreements, gross margins would still come in well above the peak margins Micron has ever hit in any previous industry cycle. That's a floor, not a ceiling.
In an industry historically defined by unpredictable swings, that kind of locked-in visibility is exactly what tends to justify a higher multiple from the market, because it removes a huge chunk of the downside risk investors used to price in.
To put the scale of these deals in perspective, these agreements collectively cover roughly 1/5 of Micron's total DRAM output and about 1/3 of its NAND output. That's not a side deal with one customer. That's a structural shift in how much of the company's future production is already spoken for. One of these agreements is with Anthropic, covering collaboration on memory and storage architecture design alongside alongside a direct supply arrangement, and it's part of why two separate Wall Street analysts raised their price targets on Micron the same day it was announced. More than half of Micron's revenue is expected to eventually flow through contracts like these once they fully mature, which is exactly the kind of shift that turns a boom and bust commodity business into something the market is willing to value more, like a subscription business. Reason number 3 is valuation. And this is the part that surprises people the most, given how far the stock has already run. Despite climbing roughly 800% over the past year, Micron still trades at around 18 times forward earnings. On the surface, that might not sound cheap, but compare it to what analysts are actually projecting. Consensus estimates call for earnings per share growth of over 800% in fiscal 2026, followed by another 110% growth in fiscal 2027.
When you put a modest multiple like 18 times next to growth numbers like that, the stock starts to look inexpensive relative to where its earnings are heading, not expensive. This is the same logic that shows up whenever a company's growth rate is dramatically outrunning its valuation multiple. The market hasn't fully caught up to pricing in that earnings trajectory yet, and that gap between current valuation and expected earnings power is a big part of why Wall Street's strong buy consensus rating on the stock has held firm, even after the massive run it's already had.
So let's connect these 3 threads together. You have a supply-constrained market handing Micron real pricing power through at least 2027. You have contractual agreements worth roughly $100 billion in guaranteed revenue that convert a historically cyclical business into something closer to a subscription model. And you have a valuation that, even after an 800% rally, still looks reasonable next to the earnings growth analysts are projecting. None of these 3 factors depend on some speculative future breakthrough. They're built on contracts already signed, supply constraints already confirmed by management, and earnings estimates already published by analysts covering the stock. Now, does that mean $2,000 is guaranteed? Of course not. This is still one street analyst's price target, not a certainty. And a stock that's already risen 800% in a year carries real volatility in both directions. Memory has always been a cyclical business, and cycles eventually turn. But when you separate the noise from the actual mechanics driving this rally, tight supply, locked-in contracts, and a valuation that hasn't caught up to earnings growth, you start to understand why serious analysts are willing to put a number like $2,000 on the table.
Whether that target gets hit or not, this is a case study in how AI infrastructure demand is reshaping an entire industry's economics in real time. If this kind of breakdown helped you understand what's actually moving a stock like Micron, subscribe to the channel and hit the like button so more of these deep dives find you. I'll see you in the next one.